Anthony Bolton, who has achieved 20% returns per year heading up Fidelity's Special Situations Fund, joins us. And as president of investments for Fidelity International, you now manage the China Special Situations Fund. Nice to see you, Anthony, this morning.
Good morning.
Good morning to you. Before we talk about China, I first want to get your assessment on the top headline this morning, which is the settlement of Goldman Sachs with the SEC.
Yeah, I really don't. I mean, I haven't followed it closely, so I don't have a strong view on it.
What about the case itself? Obviously, you must have read up on Goldman Sachs and that case being brought against it by the SEC with fraud allegations. What did that make you think? How did that make you feel when you first read about that headline?
These things happen from time to time. I still think Goldman's is probably one of the best investment bankers in the world, but I really haven't followed the case in detail.
Okay, well, let's talk about China then, because, you know, as I mentioned, you're expecting an equity bull run here. You're saying valuations are compelling. In fact, I've never seen Shanghai that cheap. We're looking at maybe, 14 estimated PE right now. What makes you so sure that we're going to see a bull market run here?
Okay. My view is that the world last year entered a bull market that was a multi-year bull market. So I think we've had the first leg of it. This is the first big consolidation that we've seen in the bull market trend. And I think later this year, the bull market's going to continue across the globe. So it's not just something I see unique to China. On China, I mean, if you look at the domestic shares, we've had a 12-month bear market actually in the A-share index. Sentiment is very negative at the moment. And I think as now, you know, we see the China economy is slowing, I think probably the catalyst will be a belief that the authorities now will change from a tightening to an easing mode. And I think that will be one of the factors that will turn around the market later this year.
Yeah, what makes you so convinced right now that we're in a bull market run? You know, we still have concerns about double dip. Yeah, we have, you know, some slowing numbers out of the U.S. in terms of the economic recovery, the European debt crisis.
Yeah, my views are probably not as strong as they were at the beginning of last year, where I thought all the stars were aligned for a new bull trend. But my view for a while has been that we're in a low-growth world. I don't think it's a double dip. That's my personal view. I think it's just going to be low growth in the West. But in a low-growth world, there's a lot of money around. Interest rates will remain low, and they have to go somewhere, and that money will go back into risk assets, in my view.
And what about the reaction to the ag bank? Let me just ask you about the agricultural bank IPO, because you like financials.
I do, in general,
but we saw this ag bank debut pretty much flat in Shanghai trade. You know, it's a volatile time right now to go public. But if you look at these Chinese banks, do you see that there's still value left in these shares?
Yeah, I mean, in my fund, the areas that I like are the plays on the growth of the domestic economy. And I think if you're going to play that, financials has to be one of the areas that you invest in. My preference actually is more for the medium-sized financials than the very big ones. I don't have a strong view on ag bank, actually. But I think, you know, say take an area like insurance. Insurance is going to be a big growth area in China over the next 5 to 10 years. And, you know, as a play on the domestic economy, I want to be involved in that.
And what about the report this week coming out from Fitch, you know, really questioning the quality of loans that these Chinese banks are doling out these days? In fact, they're saying that Chinese banks are underreporting the amount of loans that they're shelling out to the economy. Yeah,
I mean, these have been the things that have worried investors, and that's why valuations are where they are. People have been worried about the local government finances, about the property downturn, etc., about the big credit expansion last year, all these producing bad debts. And bad debts will certainly go up at the banks, but I think it's containable. I don't think it's going to be of the magnitude that really will worry long-term investors.
And now you've heard talk about a bubble, of course, on the mainland. Is there a bubble in the property sector? You're not saying that there isn't a bubble. You're saying it may take longer to form and burst, right?
Well, there isn't a bubble at the moment.
You don't think so?
What, in shares? Definitely not.
What about in the property sector?
No, I talked about shares. In the properties, the only place that I saw a bubble was in the property market earlier this year. Now, we've seen in April the toughest measures that the Chinese authorities have ever taken to cool the property market. I think that's good news. I think that they will keep these measures in place for a while because I think they really want to cool the property market down quite a lot.
Yeah, and let's talk about your, I guess, your way of investing, because you've written a few books on how to invest.
Yeah.
You're known for investing in companies with good cash positions, making cash, right?
Yeah.
You're also good at picking these companies with good balance sheets, and you prefer smaller companies than larger ones, and ones that might be subject to takeovers. Now, people have argued when you started up your fund, there was a lot of media and hype around it, that it's hard for investors in China to look for this transparent numbers, because it's an economy that's so opaque.
Yeah.
Have you had to change your investing technique when looking for shares and companies to buy up in China?
One of the attractions of coming to Hong Kong and looking at the Chinese market, that it reminds me a bit of Europe when I first looked at the European stock markets in the 1980s. It's much less well researched, much less well developed than the Western markets are today, where it's very difficult to find anything that isn't well covered. I can find, particularly in medium and small size stocks, and especially in the small ones, companies, that no broker writes about, or where the broker reports are 9 months out of date. That's very unusual in the West to find that, and that gives real opportunities. In terms of my style, I think the only change, there are two broad groups that I'm interested in here. The companies that I think can grow significantly over the next 5 to 10 years, those generally are on valuations above Western valuations, but the growth is higher. I try to buy stocks perhaps on a 1 year forward PE ratio ex cash of under 20 times. I think that's reasonable for the sort of growth you're going to see. And I try and find business models that I've seen in the West, that I've seen that work in the West, where you can buy them in China at a much earlier stage in their development. That's sort of one group. The other group is generally small companies where the valuation is at a discount to Western valuations, where I think there's reasonable growth.
Okay, Anthony, thank you so much for dropping by. Have a great weekend. Nice seeing you. Anthony Bolton of Fidelity.